Good day, everyone. I welcome you all to the 7th teaching of month 3. So today we're going to talk about smart money tool, or you can also call it smart money technique, the SMT. All right. What is the smart money tool or smart money technique? It is the analysis of correlated assets or the relationship to inversely correlated assets. The purpose is to determine what the smart money is accumulating or distributing. For currencies, using this technique, dollar index, that is the DXY, is best used to analyze market correlation. Every price swing should be carefully studied to confirm market symmetry. So we know that market correlation has to do with two different assets that move in tandem. They could either be inversely correlated or directly correlated. What do I mean? Let's take, for example, the DXY. DXY is a dollar index. The dollar index consists of the euro, the pound, and some other foreign currency. That is the major currency. And they have different percentage. Euro is the highest percentage in the dollar index. I won't be going into that for now. I already covered the dollar index in our first month, the Forex basics. So if you want to know about dollar index, you can go back to the previous lecture, or you can just go online and browse it. So now the dollar index is correlated with foreign currencies. It measures the strength of dollar against other major currencies. I know with major currencies, we have the euro, the KER, the pound, Swiss, Aussie. So all these currencies are measured against the strength of the dollar. So it's the best to use as a correlated asset against the foreign currency. So what do I mean by correlation for those of us that don't know what it is? Now, let's take, for example, the DXY is an asset class. If the DXY is trending, let's say is an uptrend, and then let's pick pound, a foreign currency. Since the DXY is a measure of the strength of dollar against foreign currency, we want to see pounds in a downtrend, meaning that the DXY is inversely correlated to the pounds. Then for a direct correlation, the Canadian dollar and gold are directly correlated. So if gold is trending, the CAD also should be trending. So this is direct correlation. So I hope you understand. If the CAD makes a higher high, I want to see the gold make a higher high. But for the DXY and the pound, if the DXY, the dollar index, makes a higher high, I want to see the pound make the lower low to take out the low, while the dollar index take out the high. So market symmetry is confirmed when these two different correlated and or inversely correlated assets are moving in tandem. So that should be clear enough for us. So now, there's a tool that we can use to determine when market makers are accumulating and when they are distributing. So as we go on in this lecture, we're going to be understanding that. But for now, we should understand that we have different asset classes that are correlated to themselves directly and so inversely correlated to other assets. So correlation is very important. And assets that are correlated, we want to see them move in tandem, we want to see symmetry. But when there's no symmetry, there's a tool we could use to discover or to fish it out. And the name is the smart money technique. So how do you use the smart money tool or the smart money technique? Compare every price swing in the dollar index with the foreign currency you trade. So whatever currency you trade, you may trade the CAD, USD CAD, the Aussie, British Pound USD, Euro USD. So these are the major currencies. As DXY trades higher, expect a lower price in foreign currency pairs. So as DXY is making a higher high, we want to see a lower low in foreign currency because the DXY is the measure of the strength of the dollar against foreign currencies. So we want to see them move in different or opposite direction. If the XY or a foreign currency fails to move symmetrically, That is, if dollar makes a higher high and then a foreign currency you trade does not make a lower low, then smart money is actively trading. Then the reverse is the same for a bearish dollar index. As DXY trades lower, expect higher price swing in foreign currency pairs. If DXY or a foreign currency fails to move symmetrically, smart money is actively trading. Okay, so now let's see what this means. In symmetrical market conditions, when the DXY makes a lower low, foreign currency makes a higher high. This confirms price action and underlying trend is likely to continue. The idea of stocking reversal patterns in this condition is not high probability and should be avoided. First of all, I would like to explain to us when there is symmetry in the market. So we know that dollar index is a measure of the strength of dollar against foreign currencies. So if it is trending downwards, we want to see foreign currency going upwards. So we can see that dollar index made a lower low, taking out the previously formed low. So we want to be seeing a foreign currency making a higher high to take out the previously formed high. So this here is a symmetrical market conditions. Now, why is this important? When there is no symmetry in correlated assets, it reveals smart money trading. What do I mean? It means the market is about to reverse. So we're going to see how that plays in the next slide. In a non-symmetric market condition, when the DXY makes a lower low, foreign currency fails to trade higher than the previous form high. This is DXY SMT divergence. So now you can see that this is a DXY and then it made a lower low. But the foreign currency failed to make a higher high. So this is a smart money divergence. This is a telltale sign that smart money is actively trading and market is about to reverse, meaning that if DXY has been trending downwards or it has previously been in a downtrend, it's about to reverse to go higher. And then if the foreign currency is in an uptrend, it's about to go lower to form a downtrend. So when we see this non-symmetrical move in price, we can trust that market wants to go lower for the foreign currency and then DXY, that is the dollar index, wants to buy higher. This does not confirm current price action and underlying trend is likely not to continue. It means that if dollar has been going lower and foreign currency has been going higher, but then fail to make a higher high, then the trend would likely not continue, but reverse. The idea of stocking reversal patterns in this condition is high probability and could reasonably be considered. Sorry, I wrote avoided. This is a typo. So now let's look at an example. Using the smart money tool, we can see that as DXY is making a lower low, the Euro USD is making a higher high. And then we can follow it here, making a lower low. So we see this downtrend, so this uptrend. So these two assets are inversely correlated. So if dollar is trading lower, Euro USD will be trading higher. Well, coming to this point, you will see that there is a divergence here. Euro USD made a lower low as it dips into this fair value gap. We can see this fair value gap here. But DXY failed to make a higher high. This is telling you that dollar is weak and smart money are already selling dollar. They are not allowing dollar to go higher. So there is a huge selling by the market makers here, not allowing dollar to press higher. And then here we are seeing a run on liquidity. We classify this as accumulation, and then we classify this as distribution. So smart money are distributing their orders here to take out liquidity to run higher for this high. But here we see that dollar fails to make a higher high. So there is weakness in dollar. So if we see this happening, we will not be deceived, but that market wants to keep going low because we can see that the Euro USD here, which is the foreign currency, formed a trend. And it also continued the trend here, forming a lower low. Looking at this, before these candles are being printed, this up candles here, we are seeing here, we will think that market wants to continue going lower because why? It has formed a trend. But because you are able to catch these in the dollar index, you see that dollar failed to make a higher high. You know that the market is getting ready to reverse. Now, look at this market. You will see that market has formed something like this. Let me just draw it out. Swings. Do you understand? You can see the swing. So we know that this move here is just a retracement. But when we see this, we know that the retracement has come to an end. Because why? There is smart money divergence here when compared to the Euro USD. We can also see here the Euro USD formed swings here. So we know that this move here is a retracement. But how do we know this retracement has come to an end? When we see this divergence. Euro USD forming a lower low, but the DXY failing to form a higher high. So let's go down to a lower time frame so we can see it better. So this is a lower time frame. This is the DXY, this is the Euro USD. So you can see how the market moved in tandem. That's this the Euro USD currency, the foreign currency moved in tandem with the DXY, dollar index. But at this point, when the dollar index was filling in this fair value gap, we can see this fair value gap here. In a higher time frame, the fair value gap began from here to here, but in lower time, you can see this point here. You can see how market failed to make a higher high to take this high. But then in the Euro USD, it made a low to sweep out liquidity. So when you see this in the DXY, when the Euro is forming a lower low, but the DXY is failing to form a higher high, you will know that this is not a continuation of a trend. It is a sweep of liquidity. This is what we call liquidity grab. This here will trap sellers and they're leaving their stop loss above these highs here, which will provide liquidity for smart money to trade higher. So we can see how it moves beautifully. So we can pair this with the PDRs, which I'll be teaching in month 4. That is the institutional support and resistance level, the order block, breakers, fair value gap, and so on. So we can pair this. Remember, in the higher time frame, this was a huge retracement in a bigger swing. But we're able to use the divergence to tell when the swing has come to an end. Because most times, you need to know when the trend is changing. One of the ways to know when a trend is changing, when a trend is forming a reversal, is to use the smart money tool or the smart money technique. Now, let's go to the chart so that I can show you an indicator you could use in implementing this tool. All right, so this is a British pounds. I'm going to be using it to show you another example. So what you do is when you come to your chart, you come to this plus sign here. You can see this plus sign. So you click on it, and then whichever asset class you want to compare your foreign currency to. And you know the best is the DXY because it's measuring the strength of the dollar against foreign currency. And we can see that the British pound is paired against the USD. So you want to correlate the DXY with British pound USD. So you come here and you click new plane. So you can see how the dollar index moves in tandem with the British pound. So you can see it made a higher high here, and then a lower low. British pound made a lower low and a higher high. And then you can see how price move together. But then there's a divergence here. Look at this high. From this point here, you can see. So this is look down here. Look at this point here. You can see this is 28th of December 2023. And at this point here too is 28th of December 2023. So if I draw my line here, this same point, you would see something. You would see that the British pound made a higher high, but the DXY did not make a lower low. So there is divergence here. And then you can see how market rallied downwards. Now you'll see from here, let's assume this point is unknown to us. You see how market was trending. Meanwhile, the DXY was also in a downtrend. But when it got to this point, it reversed. So here we see that the smart money are building, they are accumulating orders, they are buying. So this shows strength in the dollar. And here the smart money are distributing. So if you see this smart money divergence, you know that this run on this high is a sweep of liquidity and market wants to reverse. And look at how market reverse beautifully. So if you see this happening, you will trust that this order block should hold as price returns to it. It should resist price from going higher. So we can see here that price return to this order block. Institutional order flow is bearish. You want to see every institutional level hold price from going higher. Then you can see this order block here, this order block here. You will trust that this order block will hold price for price to run to take out liquidity. Looking at this point here, I want you to find it yourself. There is smart money divergence. Look carefully. This point here, you can see there's a smart money divergence. Can you see it? Okay, let me show it to you. You can see this low here, and then you can also see this high. This low failed to take out this low. Meanwhile, the dollar index made a higher high to take out this high. So you can see that there is strength in the British pounds. Smart money are accumulating their orders here to buy. But in the DXY, that is the dollar, they're taking out buy stops above price to run down price lower. So you can see how price moved lower here. With this divergence in play, you will trust that these institutional levels will hold price. You can see this other block here. You see how price found support here to rally to take out liquidity above the market. Now let's look at another example again. You mustn't use this tool only in higher time frame. You can also use it in your daily trades. So this is the 15-minute time frame. I want you to look at this closely. So this is the British pound USD. Now at this time, 10:15 p.m. to 5 a.m. in the morning, this is US time, New York time. You can see that the London low took out the Asian low at this window of time. Now let's go to DXY. This is the Asian high, but the London high did not take out the Asian high at this same time window here. And then you can see how price fell. So there is divergence, there's DXY divergence with the British pound dollar. Now, you can see that if this happens, you will trust that every other block fund will hold price to go higher to take out liquidity. So let me just put it here. This is buy side liquidity. Let's just put it here. I think we should give this a different color. Yeah, perfect. So now let's look at this again. The British pound traded lower at this time at the London session, the London open. This is the London Q zone. You can see how it took out the Asian low. But in the DXY, it failed to take out the Asian high. So there is weakness in the DXY. You can see smart money accumulating their sell orders here. You can see how market stalled, and then at the London open, the high form could not take the Asian high. So this is a telltale sign that the market wants to reverse. So you can pair this with your day trades. Now you can see that as market took out the Asian low, it formed a bullish order block. This consecutively down close candles. Now the moment price runs above this high, that is the high of this consecutively down close candle, it confirms that this here is a bullish order block. Moment price returns, you expect that it will hold price to go higher. Now, you wouldn't want to take your trade because this is not in the New York Q zone. Here you can see it's not in the New York Q zone. You want to wait for the New York Q zone to set in before you take your trade. And then you can remember from our previous lesson when I taught protraction, and I say protraction will occur 7 a.m. expected to occur after 7 a.m. So you can see this protraction coming down, finding support in this bullish order block here before running to take out liquidity above the market. So I've explained how you could combine the smart money tool with protraction, institutional order flow, institutional support levels, and then kill zones to take a day trade. With that being said, it doesn't mean that when you just see divergence with your foreign currency you trade and then the DXY, you should take a trade. No, you want to combine with other things. So the smart money tool helps you to screen out reversals to know when a trend is coming to an end. So if you're looking at the DXY and you're looking at the foreign currency you trade, you want to be looking out for divergence to tell you that the trend is about to change. And as always, I wish you all good luck and good trading.